Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today. Hello and welcome to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. And this week's episode, we're doing a little bit something different. We've got a panel that we recorded at the Minnesota Real Estate Exchangers group. We did that a few weeks ago, and now we're going to play that for everybody. We had a panel of four seasoned investors, real estate investors, and commercial brokers that came up and shared their experiences, shared their thoughts on the market and what's going on, thoughts on trends and what they're looking forward to, what they're working on, and maybe what they're a little nervous or apprehensive about as well. So we went through and, like I said, did that panel, asked a bunch of questions. A few came from the audience as well. So I think you're going to get a lot of value out of this episode and what's going on. It relates a lot to the Minnesota market, but it can be also translated into a lot of different markets as well. A lot of the same trends are going on throughout the country. So follow along. You will, I think, like I said, get a lot of value. Well, first, let's start off. We're at Minnesota Real Estate Exchangers. And I've got a panel here with four gentlemen who've been all involved in real estate in one way, shape, or form for quite some time. So let's start off from the left with Scott. Introduce just yourself and what your company is, who you're with.
My name is Scott Miller. Currently work with Keller Williams, KW Commercial in Woodbury. Been doing construction and real estate all my life.
My name is Todd Wilson. If you all know who I am. The LLC that I work for changes on a monthly basis, but I am a broker with Thor Commercial Real Estate. I'm an entrepreneur. I start different things all the time, but they generally have the basis of some kind of real estate in some facet. So started flipping houses many years ago. I'm an accountant out of college, and morphed that into more of a commercial triple net restaurant type thing.
So Todd, real quick to qualify, the LLC's changing all the time. It's not because of criminal activity, it's because of flipping business, correct?
Depends on who you ask, but when we get into a new venture, we always form a new LLC. Dave, I think, has set us up a couple LLCs over the past, and just to cloak our liability. And like if I buy a fourplex or a 10plex, immediately put that into an LLC and then move forward. Even if I'm doing our Dunkin' Donuts, into an LLC, they're always changing. But the root of what I do, I'm a commercial real estate broker.
Perfect. I thought there'd be a lot of head scratches with that. He switches LLCs all the time.
No, Todd's a good guy. We've done stuff together before. I'm Ian Colville with Carpathian Capital. My background is investment banking prior to getting into real estate. Raised some money from investors, started out buying houses, and then moved on to buying some commercial buildings, and have now gotten into hard money lending, and next month we'll be raising a new fund to do new build, bridge, construction lending. So on the buy and hold side of the business, we own about $50 million worth of stuff, houses and apartment buildings. And again, we've been doing, 2017 was hard money lending for us, and then 2018 we'll continue that, and we'll be doing new construction lending.
Bill Lickett, Crown Senior Living. Been in the development business for a little over 40 years. We did everything from land development to purpose-built senior housing, apartments. Today we are buying existing hotels and converting them to senior housing, primarily senior living, and memory care units.
Let's hand it back over to Scott. Scott, you didn't really explain too much of what you're doing. You just kind of gave a little quick. So why don't you tell us a little bit more about you?
Great. I'm a St. Paul boy, Minnesotan, true Minnesotan. Born, bred, raised. Don't plan on dying here. I think we die in Florida, Arizona, and other places. But no, I've been in the construction business many, many years. Grew up in St. Paul, doing restoration work on older buildings. I love tearing them apart, putting them back together. My nickname was Sawzall Scotty. Then I kind of got into design sales for many of the major remodelers in this town. After that, I became a certified building official, limited license for consulting, and it was great. I was thinking someday be a building inspector, but it worked very well with the gentleman I worked with for about 10 years, Herb Marcolis and the Seneca Group. We were owner's rep, probably worked on about $100 million of the owner's rep construction oversight with him. And then I got into real estate twice, once in the 70s, I know, not 1870s, 1970s, for a few years, but always stayed in construction. They got relicensed back in 2004, and I joined Keller Williams. I'm one of the original 10 KW commercial agents within Keller Williams International. I was just reappointed to their international leadership council, and I'm president of Minnesota Real Estate Exchangers for the second year in a row. So that's primarily what I do.
So I want to jump into it because it's 2018, and we're seeing the stock market do all kinds of funny stuff. I think there's a lot of people that are wondering what the heck is going on in the real estate market. As everybody knows, obviously we crashed down hard, hit bottom somewhere around maybe 2011 or so, and we've been climbing very steadily since. So I want your opinions on where you think we are in the state of market right now, and where we're heading. Take us through, the next few years. So whoever wants to start can start. There's two mics up there, by the way.
Okay. Personally, I think there's some real issues in retail. And I think great. One of the best parts is we have Mark Robinson coming in 2 weeks. It's also a plug for him. Mid-America shopping centers, I think, is probably going through real growth pains up and down right now. I think you're going to see some real innovative things. I think they even coined a word, experiential. You're supposed to go there for an experiential experience now, where they're changing the whole format of shopping centers. I think industrial is very, very strong. Office, I think, is going to be weak, especially in suburban areas. I think land will hold steady. Multifamily, I don't know how much more people can bid those up, and where people can find money to live. I think we've got some growth pains. I truly believe we're at the peak of where we're supposed to be, and I think we'll have a little healthy retreat. But this is also a great time to grab market share from people in the business, because they're going to be going down.
I would agree with everything that Scott says there, from the different asset classes that he's talking about. I do also think that we are at or near peak. I think, though, with some of the other economic indicators that I see out there, I don't see this taking a nosedive anytime soon. So if you are if you've been around long enough like Scott has, you've seen a couple peaks and troughs through your career, and until you start seeing the craziness happen where money is just getting thrown around, I think you ride this a little bit longer. I use Stuart as a rebound board. He's got his finger on the pulse of all the activity and some of the multi-housing out there. Use your peer groups to figure out what's going on. As they'll say out there, if there is some fear out there, it's maybe a little bit more time to buy, and I think that there's some people getting scared and getting out. I'm one of them. I sold a big asset a couple months ago just to hedge my risk, but I also think that everything that I see out there is positive moving forward. I don't see any sign of things going the other way. So although some things are tightening up, like some of the malls and some of the big retail are tightening up, there's an opportunity in that tighten up. So I just look around. I'm a retail guy. It is getting strange, but then I just move into back into the residential world. The foreclosures are starting to pop up all over the place again out of nowhere. If you guys look at the paper, for the last couple of years, there's been nothing. Now there's 3 sections in foreclosures. So now I have crews out there flipping houses again. So where there's strength here and weakness here, use your mind to move around and find value where it is.
The economy's strong. Everybody knows that. The stock market fairly or valued or expensive. So we're starting to see the hiccups there. That's partially been a product of low interest rates, and we're starting to see interest rates go up. So that will have some sort of an impact on risk assets, and the stock market's probably the place that's going to happen first. We saw that this week. So existing assets are expensive, and that includes real estate, in my opinion. We haven't bought an apartment building since 2013. We bought the office buildings down the road here a year ago, and we haven't found anything that we like since then. But there's still a tremendous shortage of we have a tremendous shortage of housing, which is an interesting change over the last decade or so. And we're just this past week, starting to see signs of wages picking up. So the people who owned assets after the crisis, which is probably a fair number of the people in the room, we've all made money on the assets we owned. But the working segment of the population was not enjoying the benefits of asset prices going up. We're just now seeing wages starting to go up. So there's going to be more buyers out there for things at a time when we haven't been building enough housing. So we're moving into construction lending as a way of taking advantage of that. Oh, and one other note that I'm interested in is as rates go up, a lot of us, myself included, we've financed our projects using 5-year debt. I hope I'm still standing when some of the 5-year debt that's out there on apartment buildings and other things matures, and perhaps the current owners are not able to refinance at the new rates. So that's an interesting opportunity.
And just to give him some credibility, why don't you tell him how many single-family homes you are currently managing, so establish the...
We have about 400 of them.
So he's hearing from 400 people on a single-family side of management, how wages happen, vacancy levels, all that on an individual PID.
Vacancies are very low. Our rents are going up. Every time we put a house in North Minneapolis on the market, we have cars lining up out front. So stuff that people were telling me a few years ago I'd never be able to sell is in demand because nobody is building homes for under $250,000. Right. So if you want a home for under $250,000, you're going to North Minneapolis and East St. Paul. If you want a home for over $300,000, you can probably buy it out in the suburbs, new.
Well, I've been in the development game for over 40 years, and as I think about it, the reality is we can finance it, we will build it. And that works good in up markets, and as we all know, that market goes up and down and sideways a little bit, but mostly up and down. We went through a period, obviously, a few years ago when it was unlike any period that we've ever been involved with, where it was down, down, down. And we lost our ass in that marketplace, like anybody that was in the business did. And we were building primarily assisted living projects, purpose-built, ground-up apartment buildings, land development. And now we're a little bit older, and we're no longer interested in the long-term development process. Purpose-built assisted living project typically take about 4 years from the time you set a load of the project till the time that you had a certificate of occupancy. That's a longer term than we're interested in today. So what we're doing is we're taking the expertise that we had in assisted living and buying hotels and converting them to assisted living projects with the objective of about 18 months having CEOs and be filling those projects. So we think as far as where we are in the marketplace today, there's lots of money available chasing deals and chasing financing. And so we are pretty active in the market. We've got half a dozen projects that are either completed or under construction around the country. And we are now looking at, we look at a lot of hotels to find one that feasibility-wise works as assisted living projects. And so we pass on 90% of the, 99% of the deals we look at. But we think there's a market for small units, converted hotel units into rental residential use. I've got an article here in the Pittsburgh newspaper, actually U.S. News Today, about a Pittsburgh project, 360 square feet, furnished units, renting for $1,500 a month. And so we're looking at that, doing taking hotels and converting them to residential use. Now, we have not done one yet. We are looking for those projects, but we think that's another offshoot of the conversion project that we think we can make work.
Hey, Bill. Question, is the stuff that you're doing with these hotel conversions, would that be considered market rate or affordable?
Well, they're market rate, but they are less than purpose-built ground-up buildings. The cost per unit, instead of being $350,000 per door, is probably more in the $200 and $250 a door once we convert it. So the objective is to be under the market. Obviously, we get as much as we can, but we're under the market, which opens up the amount of prospective users for our project. Yeah.
Okay, then one other question, we just want to follow up. On these properties that you eventually determine this is where you want to be, what kind of communities are we looking at? Or are you looking at?
Typically larger population areas. We have 2 projects in Tallahassee, one in Cleveland, suburb of Cleveland, Pittsburgh. So they're large populations to draw from. Smaller, you don't get the rent, and you really have a hard time making it work in small density locations.
All right, so I want to move on to kind of, what's your current, and you can, some of you have covered this, so if you want to just pass it, that's fine, but what's your current strategy that you're implementing or your clients are implementing that you really like in this market, and how are you executing that to be successful?
Great question. I think you have to almost be, like Todd was saying, the chameleon real estate agent. You gotta kind of change your stripes, be a zebra. I think you have to expand your market and where you are going to be strong and where you're not. I don't think you can be relegated to keep your feet in cement in the past. So I think you have to pursue different areas. I think there's some, there's always markets somewhere. Right now, I know, like you were mentioning, North Minneapolis, Northeast Minneapolis. I think there's parts of St. Paul that are exploding a little bit. Rice Street, Arcade, and Payne Avenue actually coming back. Payne Avenue has some of the finest restaurants in the metro now. So I think we're going to see some movement more into ethnically dominated areas close to where St. Paul's building a soccer stadium. I think we're going to see growth in that area, University Avenue, all the way to downtown now. It seemed to have stalled for a while. So I think you just have to be nice to everybody and find out where the market is and where buyers are buying and sellers are selling. I think truly people have to step up their marketing. This is the time to go after market share. This is the time to get out, meet and greet people, let people know you're in the business, show up at different events, marketing events. I think one of the things we passed out is there's a small business expo coming up in May, and I've done that one before, and I asked our board, do we want to be in there, just so maybe we can expose ourselves to additional people looking for additional contacts. So I think that's probably the biggest thing, is get out there and network to find where the market is and go with that.
Just to play off of that, like you're saying, being a chameleon, just morph. Just to correct you, when you started in the beginning, saying the crash that happened in 2011, I got to disagree with you. That started in 2005, 7, because I was already broke by 2008. So it was been going on a long time. So I felt it. It was going on. It was almost starting to correct by 11, or at least I came out of the hole. So that said, when that was going on, I was running a real estate firm. We had about 15 agents at the time, and we were buying and selling as fast as could be. I couldn't believe how awesome it was. Condos were flying off the shelf. All of a sudden, it just stopped dead in its tracks. Lending stopped, and we turned into a property management company because we couldn't sell anything. And the thought on that was, we're just going to plant our own seeds, and when these things come back around in 6 months and the recession's over, we're going to have all these listings that are out there. Well, 6 years later, we were still a property management firm, and it never came back around. And then 2013, whatever came around, or 12, and we were back in the game again. But what I'm saying is, move around. And I will say, and Casey can be a guy that can talk about it, one of the canaries in the cage of 2006, 7, 8 was all of a sudden the condo market just took off out of nowhere. It was single family homes, and it was a bunch of apartments, and it was condo craze, and the condo craze got into an overbuild craze, and then all of a sudden it just went to a screeching halt. So let it be known, if condos are out there and people are starting to change their apartments into condos, the end is coming, and I don't know when, but I'm just telling you, that is a canary in the cage. So just be prepared, morph, do your things, go around, and look at what things are making money.
Yeah, so the changes that we've made is we're moving to a different segment of the market, which is the new build, but we're doing it in a different place in the capital stack. We're not doing it as equity investors, whereas previously we were buying homes and equity, and we were borrowing from someone else. So we're shaving risk by being the lender, but we're adding risk by doing it in new construction. So hopefully we'll get similar returns for our investors, but doing it in a way that will prolong our life in the market as a result of that shift.
Well, I'm not a very good example of this, but I will back up about moving around and getting out of your comfort zone. I was just relating to our guest back in the early 70s when I got into this business. We developed a project up in Anoka, and our partner and I were sitting around one day with nothing to do. We said, well, let's get out and just go for a ride. So we went for a ride. We wrote down 5 phone numbers, 6 phone numbers, and for sale by owners of land out in Ramsey County. And out of those 6 phone numbers, we did 4 deals. And it's a matter of getting out of your office and going and see what's happening in the world, I think, and then decide to do something about it.
Yeah. Easier said than done, right? You hear it, and it's so easy just to sit and be comfortable. Yeah. So we got a question coming up here.
Yeah, my question is, where are you guys finding any deals that you're currently looking at? How are you sourcing what's out there? I guess more for the kind of buyers, but you're looking obviously across the nation and some here. What are you guys using to help kind of drum those up?
I mean, I can take that for a while. Well, on the commercial side, I'm finding that the face-to-face networking is still alive and well. Certainly in the commercial side, when we're talking about asset classes like hotels, big developments. I'm involved also with the NCE, which is a national exchange group, and SEC, which is going to be coming here to Minneapolis here in a couple months. These guys are still doing deals amongst themselves. Even though the internet now is becoming a huge draw, there is still a lot of relationship sales that are happening at that level. I don't know if, how many realtors are out there, but that new Remind Me or whatever, that new program, I don't know if anybody's realtors out there. That is super powerful. I don't know if anybody's been playing with that yet, but it's an MLS kickoff that is a search for equity. It goes to the root of mortgages, finds out what the person paid, what they have left remaining on their mortgage, and then gives you an ARV or an appraised value based on the comps around, and it tells you how to go to that buyer or that owner, and because of the big equity spread. That is public knowledge, and it's part of the software that you're paying for through your MAR and NAR and SPAR dues. So I would highly recommend looking into it. It's super powerful. I just went to a class on it the other day, and I can't believe that's public knowledge. So for you residential guys out there, that's a huge asset for being a realtor.
What is the name of that?
It's REMINE, Remind Me, or I don't know how to say it. Remini or something like that.
Webinars on it or something, so it sounds like something to pay attention to.
Yeah.
Myself, I leverage residential agents. I love them. I treat them very nicely, and they're 40 to 80% of my business. So I hang out at my office. We have 240 agents in there. They're Keller Williams offices. I get referrals from. I know our meeting we had, and it was very nice that they let us do their office, Keller Williams Edina. There was one gal in there, the residential agent, said she was looking for land. Right now we've got, hopefully her buyers are coming to the land we have in Wisconsin, so you just never know where it's going to come from. It's a great model, residential agents and other services. Your bankers, I know Paul Ponson's going to be talking about, I don't know if it's now, but a nice package deal he ran into. So, I mean, that's why we come to this group. So there's this group and other ones too, but mostly my main source of leads is from residential agents.
Work, business, leads.
I don't have anything magical. With lending, it's networking and advertising, and something we haven't had to do before is sort of mass advertising and marketing. So over the last 6 months, I'm teaching myself about those things, and we've hired a few people with connections, and I've hired a few marketing experts. So that's on the lending side. Back when we were buying more houses, we used a very interesting strategy, which I think would actually still work, and maybe it would work better for agents than it would for buyers these days. As we looked through the tax records, found everybody who owned more than 3 houses, and sent them all letters and said, we want to buy packages of homes versus buying one at a time. And we were the only bidders on packages in a lot of cases. So if you want to buy one house, you'll have to deal with all the competition via the MLS. But if you can buy 5, there's almost no competition there. And for agents these days, I would be tempted to go find those people and somehow organize your buyers so you could also buy the whole package, as opposed to having to somehow process them one at a time. There is a segment of sellers out there that don't want to go through the hassle of selling one at a time.
Yeah, that's genius.
We have a computer guy who, in addition to doing your websites, is looking online for hotels around the country. And that being said, we've got 6 that are currently under contract or under construction in some phase. Out of those 6, 4 are through referrals from the first owner we did, and that owner had other owners throughout the country who were basically the same kind of situation where they own hotels, and they had some that were not working and they wanted to sell them. And so 4 of those projects that we're involved with were through referrals from our initial project that we bought.
Awesome. So real estate investors are always kind of real estate people are kind of dinosaurs, right? We move real slow, it seems like. But I think it's really important to be ahead of the game or trying to be ahead of the game. That's how you're going to be successful. So are there certain trends that you are seeing that you're excited about, you're interested, you're learning about? And then are there certain things that are happening that so this is a two-part question. Are there certain things that you're kind of nervous about or going, geez, I don't like what's happening in this part of real estate?
Yeah, actually, that was a great segue because I was just going to point to Ian and go, how's labor shortages going to affect you? And then long-term, the weather in Minnesota. Is that going to keep population growing here or not? Is everybody going to get the hell out of here? But I think the labor shortage, I'm going to just pass that right over to Ian because I think that's one of the biggest problems we're going to have here.
Yeah, I've solved that by being the guy who doesn't have to find the labor. I'm now the lender. And so we have challenges, sure, for taking care of our existing houses. We've just had to pay more. And then on the lending side, I'm lending to the guys that have to go find the labor. So, and that means that their costs are going to go up, and as a result, home prices are going to go up. Which means that there's no more room for us to lend, but it also is good for our existing inventory. So the short answer is I'm not hiring because it's hard.
Bill? Todd?
No trends?
Well, we've all commented a little bit on the trends, what we're doing, what we're kind of morphing into. So mine is residential construction.
Is there anything like you see though on the horizon, maybe that you're not even doing necessarily, but you see that you're going, this is something we should be looking into?
Sure.
Okay, so on the new stuff, I'll pass it down to Scott here in a second. And then on the stuff that concerns me, I think it's stuff that we've all talked about in these meetings before. Maybe we'll be overbuilt in apartments at some point. Interest rates are going up and all of us have to roll our debt. How will that impact the market? So those are the things I'm keeping an eye on.
Go ahead and no.
Well, I've been talking about that as well. As the interest rates rise, it gets tricky on a cap rate purchase on a commercial deal, especially if you don't get the longer term debt on that rate. So I'm watching that and watching how the rates are moving. I have a bunch of properties right now that all of a sudden just turned variable, and I'm looking for money to roll those in because all of a sudden they were making money and now they're tight again. So if I could say to be wary on anything is structure your debt appropriately because they are going to rise if you're in some kind of a variable situation.
Well, we're concentrating on the senior housing market. That is certainly a growth market. We're pretty much all getting older. And one interesting things about the market is the average, this surprised me, the average age of a resident in our project is 84, 85 years old. The biggest problem we have is people dying. We've got a project in Tallahassee that's about 65% leased now, and we've already had about 9 deaths in 6 months. And so turnover is very high, but the demand is very high. The demand is growing. The demand is going to continue to grow, and so we're optimistic about that. The issue for us, as I initially stated, is always financing. Can we get these projects financed? And, so that's the spigot will turn off when the financing stops.
Yeah, no money, no honey. I think two things. One area that I think is really going to take a significant drop is going to be the brew pubs and the brewery places. Way too many. I'm hearing of places that you just take over the payments on my equipment and it's yours. So I think that's going to be an industry that's going to come and go. I'm intrigued by shopping centers, and I'm really glad that Mark's coming. I think that's where you're going to see some changes, especially the B and Cs that are dying on the vine out there. I think it's going to be innovation. I think you'll see. I think that's a great place to put multifamily is in the parking lot. Maybe assisted living facilities in the parking lots. It's almost like bringing Muhammad to the mountain. It strengthens the mall there on the people who have the businesses in. It's a built-in trade. The center can easily accommodate the parking by building underground parking or garages so you're not missing that much. And if you do a shopping center that's got some mass transit connected to it, I think that may be what's gonna save our B and C malls. So I'm kind of intrigued on that concept of development and using those huge parking lots for that. I think you're seeing that now in the Mall of America where they're just adding on hotels next to it, and the thing just keeps expanding. So, with living quarters. So, and you have the huge McGough apartments not far from there. But I could see where they start adding apartment buildings right in there too, just again to create that critical mass. I think a lot of development we'll see in the future is vertical rather than horizontal. Just economics. I know Eli does engineering, and I know the community I'm in, Mendota Heights, loves minimum 15,000 square foot lots. They wanted to change that all for residential to 25,000 square foot lots. Eli, I'll ask you, what's the difference in infrastructure costs rather than in the city where it's 5,000 square foot lot to a 25,000 square foot lots?
Yeah, I mean, that's huge that's one of the main things we do. We do a lot of concept and block studies for people trying to figure out the density that they can get, how many units per acre. And that drives the land cost huge, depending if it's R1, R2, and what their setbacks are, how big a house you can fit. And a lot of some cities are going the other way and want density. And those are the cities that are getting projects. The ones that are going to the bigger lots, unless you can build $1 million house, we aren't seeing any interest in those. And people say, nope, no interest, move to the next city.
Okay, great. I agree. That's what I was wondering, where you're seeing it in crops. Go ahead.
So, fascinating stuff about the parking. If we're talking about 5 to 10 years from now, I'm interested in buildings that that are excellent buildings, except they don't have parking. At some point, we're not going to need that much parking. So we'll use it for something else, or we buy the buildings. Now is the time to buy those buildings that are underparked, and they're cheap for that reason, but I don't think that's going to be an issue going forward. I had lunch with somebody yesterday who was telling me that the city of Minneapolis, maybe it's Stewart or someone else in the room knows this better, is requiring far less parking per square foot of development, and that's only going to continue. So what happens to those parking lots that exist, and maybe buildings that don't have parking are suddenly more valuable?
Yeah, we had a 4-unit building probably 5-6 years ago. I tried to get 2 more units put in the basement, and because of the parking restrictions, we weren't able to. And now we are going to be trying to get 2 more units put in because of the changes that you were talking about. So,
With the problem with the big boxes are having, I'm intrigued with the idea, which I don't have, but if you've got a tenant that would be that you could control or work with to find locations, and if you could then go and tie up a big box on a master lease and be comfortable that you've got a tenant that can fill part of that space, then divide up the rest of the space and have that property under contract, I think there's a lot of money to be made doing that. And, but it's a little scary going in with totally naked without having anybody that's ready to take at least part of that space. Depending on the deal, I suppose you could do that, depending on your risk tolerance. But these big boxes are going black, and there's opportunity to take advantage of that.
has anybody dealt with these office spaces that are kind of just being converted to where you can come in, you can pay your fee. I don't know what they're called, but co-working or virtual, not virtual, but co-working spaces. Anybody dealt with those and had any, or have any thoughts about it?
Not straight up co-working, but in our building right down here, we're building executive office suites, which are Regis Light, and they're going like hotcakes. We've got 3 offices rented, and they won't be ready for a month. So right now, there's just cement.
Just one-offs?
Yeah, well, it's a suite of 5,000 square feet, but individual offices within that suite.
Okay.
There's just cement and some drywall in there in the moment, and 3 of them are rented.
Let me just comment on that. We did Lincoln Park Apartments in Eden Prairie, and the main floor there, this goes back to 1991, I think it was finished. No, excuse me, 2001. And we put in 70 executive office suites. And so for an office, we were charging $1,000 an office, which equated to about $36 a square foot. And so it could be a very, very good business.
Yes, it can.
God, we're charging half that. Are we undercharging?
Yes, you are. Yeah.
Holy cats.
You learned something.
Yeah.
I've got a person.
I gotta go.
To Regis, they have 1,500 square feet, paying $2,300 a month.
Yeah.
And I think they were getting a deal. I heard WeWork is, I think, the huge one now. The figure I saw is there's 700,000 square feet in the metro that's individual office type space.
Mm-hmm.
So it's just ginormous here.
Let me make one more comment on that parking thing. And this is if we're trying to pull trends out of this panel right here. I used to go to these national conventions, and everybody was saying the money's in parking lots. If you are in a city setting, if you didn't have a parking lot in your commercial building, the commercial building was worth half. And so guys would say, you know, I'm just going to buy these lots and sit on it and sit on it and sit on it because the parking is going to be it. That trend is changing because now, pardon me, hardly any of these millennials are driving. So now all of a sudden these lots need to be developed, and the value on the parking side is flip-flop to it needs to be developed. So there's a trend right there. And I also want to add on the trend is, I used to call it not so Richfield. And South Minneapolis was kind of the end of where the neat area was for any development. One of the most expensive apartment buildings in Minnesota history was just sold a couple months ago now in Richfield. And I think if there's some residential people out here, duplex people out here, the trend is going towards Richfield as they are remodeling or redoing a lot of the roads, getting ready for a gigantic renovation or renewal of Richfield. And if you know about anything about the 77 corridor and 66, they are tearing it to shreds here in the next couple of years. So if you guys are looking for residential or even on a commercial side, Richfield is going to boom here soon if the economy stays the way it's going.
An interesting trend was when we filled these executive office suites back in '91, I would say it was 90% men, 10% women. About 2 years ago, just out of curiosity, I walked through the building, and the doors are open to these in all these offices, and I would say it was at least 80% women in those offices.
Wow.
So the world has changed.
Oh, yeah.
Nobody's mentioned Airbnb yet as another trend. We've got a lot of houses. Someone recently came to me and he wants to master lease some of our houses and use them for Airbnb, and we're giving that a try. Ask me in a few months how that went.
Yeah, is that right?
So this is to Ian and Bill particular. You guys have a lot of out-of-state stuff, which speaks to me well. But I want to, talk to everybody a little bit about how you manage it out-of-state stuff and how it's been challenging and how you've had success in it.
Well, you have to have people, and so we started doing this about 3 years ago. What we're doing now, when we were doing projects in the cities here, we built up a staff. We had 36 employees, all professional people, to include architects, engineers, lawyers, accountants, and now we're kind of building up again. I think we've got about 15 people, to include a management company, which we didn't have before, that manages our assisted living projects. So bottom line is, no one person can do it. There's a lot of traveling involved. There's a lot of going to meetings and so forth, to communities and so forth. So it's a pretty complex thing, and you got to have partners and people that are competent.
Yeah, we own houses in 5 states, and if I had to do it all over again, we wouldn't be in that many states. The lesson I've learned is don't do it unless you know you're going to be big enough in a market to hire a full-time person. Don't do one here, one there. It'll rip you apart. So we've fortunately gotten close to big enough in all of our markets to have full-time people. We do have a couple markets where we have part-time people. And if you're going to do it, you have to be highly process-oriented. If your business success is all about you being the dynamic man or woman who's making all the decisions, and you're meeting with people and you're shaking hands, that's not a good strategy to expand to other markets. If you're someone who likes to sit at a computer and whip up the rules for how the business is going to run and enforce other people running the business against your rules, then you've got the type of personality that you can expand into other markets. I have a mix, so I have mixed feelings about expanding into other markets. But fortunately, a rising tide lifts all boats, and we've made money in all those markets. But in a more sort of mediocre market, we've been less successful in our other markets, and perhaps we would have lost money if we hadn't been in a strong market.
Yeah, I'm only regional, so again, it was geared towards you guys, but I can even say on a micro sense, on my residential portfolio that I own, the further away, the more of a nightmare it is to me. And so the closer you can get to your home base, I would say just logistically, it's more valuable to stay close to home.
I have no comment.
Yeah.
All right, so this is going to be my last question. Go ahead, Bill.
Just one comment on being regional. We did a project with, we officed in Eden Prairie, and we did a project in Lima Lakes. And so it's 45-minute drive up there, whatever the meeting is, another 45 minutes. So you're going to spend basically a day to go up to Lima Lakes. Well, we can go to Pittsburgh in the same amount of time.
Yeah, exactly. Yeah, exactly.
Very good point.
True.
Well, and that's true if you're going to invest in the northern part of our state. It could take you four hours plus to get there, where it could take you just a couple hours to get to Pittsburgh. So the last question, and if you don't feel comfortable answering, that's fine. But if anybody else has any questions, come up here. I'd love to have you ask the panel anything. But I'd like you up here if you can, by me. Tell me one of your biggest failures and how did you learn from it? And I know none of you really failed, but tell us one of your biggest failures and how did you learn from it?
Go ahead.
Yeah, I've got a big, sexy failure for you. We lost about $120,000 when our property manager in the Quad Cities stole the money. And I learned, so we had a property manager, we have about 100 houses there. Standard property manager model, she'd collect the rents, she'd pay some expenses and send us a check at the end of the month. First warning sign was she changed her accounting system, and that ostensibly required her to start paying us 2 weeks later than she was before. I should have started investigating it then, but I didn't. And then started seeing that every now and then a check would get lost in the mail, and she'd have to resend it. And then she just, I believe she tried to commit suicide, ended up in the hospital, and then we really kind of dug into the business. And we're still not sure where all the money went. It may have been a gambling problem. So we lost 2 months of rent and all the damage deposits for our tenants. So we've come out of pocket for the damage deposits ourselves. It wasn't our tenants' fault. And since then, we've brought management in-house. So we control the bank accounts, and we do have 1 or 2 external managers. Like for our office building down here, that's an external manager. But the bank account is in our name. It's in our property management software, and I can see it every day. So lesson learned.
Okay. On that same lesson, bigger isn't always better. And like I said, back in the recession days, we had all kinds of staff on, and you are only as strong as your weakest link. When the Department of Commerce comes after you because you have somebody that is just a knucklehead on staff and you're going to take the fall for it, be very careful. So I would say overpay somebody, or not overpay, but pay somebody that is going to have to be quality, because you're going to go down before them because you have the money. But I would say one thing, as this market is continuing to go, and some of you are gaining wealth, if I can give you any advice on a fluctuating market, try to use as little of your own money as possible to hedge risk. Because if you stick your neck out and you think that you're going to take a partner out because you want to use some of your own money, that's when the chopping block comes out. So always, always, always try to hedge your risk on not using your own money. Anyway.
Bill?
I would say my greatest failure is being a developer. When the development business is at least as risky as going to Las Vegas, maybe more so, because you don't have control When you have a project that's 4 years in the making and you've got a lot of money invested in it, and 9/11 happens, you're dead in the water. So that's a real problem. So the question is, why am I in the development business? Well, I asked my partner that one time during the past recession when we lost an awful lot of money, a lot of properties. And his answer was, well, we're not brain surgeons. That about says it. You gotta do kind of what you know. You gotta like doing it. You gotta enjoy doing it, and you take the risk.
Ted Holtz is my name. A couple of questions. First, Bill, after the Super Bowl is over, do you see any hotel opportunities in the cities?
Hotel,
Opportunities for hotel purchases in the cities now that the Super Bowl is over. I think they made a bundle then.
I guess I don't really understand the question.
Opportunities to purchase hotels hotels.
I'll tell you, I see so many hotels. Now Henry can speak to this maybe better than I can, but all the hotels we look at are hotels that aren't working.
Yep.
And there's lots of them out there, I'll tell you that, thousands of them. You know, you build a hotel in a really good location, and it's such a good location, the other 4 quarters or 3 quarters get filled with hotels and now it's not a good location anymore.
Yeah.
Or you get the flag comes along, which is what's happened to the hotel in Pittsburgh we're working on. It says you gotta spend $3 million on a PIP, on increasing and improving your property, and the economics of that don't work. So all of a sudden, you're trying to sell your hotel. So I don't understand or nor do I want to understand the hotel business.
Second question. I moved into senior living, unassisted senior living a couple of years ago. It seems like since then, just about every other corner has a senior 100-unit plus senior building going up. What do you see as the future for that? I realize there are a lot of people entering the senior era, but there's a lot of us leaving too.
The answer is there anybody in this room getting younger? So
I'll be a counterpoint to that.
the number of people that are reaching the age, and again, our average age is 84, 85 years old. The number of people that are reaching that age every day is getting bigger and bigger and bigger. And so the demand is going to be there. Now, whether they're affordable, where you get them financed, whether people can afford to live in them, that's another question. But certainly the demand is going to be there.
But that's for assisted living. I'm 83 and I'm still in the senior housing. Is that going to survive?
I would say the same answer, but we're really not in that market, so I can't really answer it very well.
I want to comment to that. Actually, I think you're going to see a huge change in that industry. One big reason, it's unaffordable. I think I was at a presentation, I'd like to get them in Ecumen. They're large consultants on senior assisted living. Most of their facilities now, maybe 10% is Medicaid, Medicare. The rest is private pay. If you don't have $250,000, they won't let you in the door. Life expectancy is 18 months. It's just plain unaffordable. I think you're going to see people moving back with their families again. There's a lot of communities in this country that is the way they do it. They're very surprised by some of the people who go to these facilities. I think the unassisted, I think that's the senior communities will be strong. Assisted living, I think it's just unaffordable, and there's going to be a huge labor shortage in that industry, huge. So.
I'm nowhere near as sophisticated and been an exposure you did. I had my little niche of buying a house and putting it together and paying for it and carrying on. And I'm pretty blessed in my little world. But baby boomers, this is the world right now. We're setting the whole chances of everything on this. What is the volume of younger people that's going to be replacing this, and how long is this supply going to last, which is everything we've just been discussing? It just it seems scary to me as to where is the retail or the housing, who's going to fill up these houses when we're not growing as many kids as the baby boom wage. I don't know if I'm saying that right, but that's just, which is already what you've just been discussing here in some way.
So are you saying we're building a bunch of these senior housing, but eventually these people are going to die. What's going to happen after that?
Yeah. No, just we're relying on baby boomers across the board right now as a society with all the stuff that's being built right now or being readjusted.
I think it's actually fairly, I have a semi-sophisticated answer. I actually need to do more research on this, but since we're just at the beginning of the cycle, I haven't felt the need to get down to the decimal point. It's pretty easy to look up the household formation rate and compare that with the household starts. And we were clearly overbuilding pre-crisis houses versus the rate at which we were building, forming households. We way underbuilt during the crisis. And as a result, there's a lot of, there's a lot of catching up to do. So there's two things that I look at and will look at more in depth as this market matures is that household formation rate and the housing starts. I know we're behind at the moment, so I haven't had to get into it in too much detail, but when I go raise money from investors in the next month, I'll have a kind of an attractive chart, which I haven't created yet, which shows the deficit. And then there's the affordability issue. You want to be looking at, are the houses that are being built, are they in line with the wages and wage growth? So that's another way of looking at the market. But I think I don't think that we're building houses for baby boomers at the moment. I think there's a lot of, and I'm in a different segment of the market, so I think there's a lot of millennials that moved into their parents' basements during the crisis, or they became renters.
We had some.
And we all told ourselves that this time is different. These folks are never coming back to buy a house again. And I think that's BS. I think as soon as people have a kid, they want a house.
I completely agree. And also know this, if you feel that the senior housing or assisted housing is getting overbuilt, that can be easily converted right back into an apartment market rate. So they're not putting these things out in the sticks. They're putting these things right downtown in these metros, and that will be the transition. They'll transition back into a condo.
Millennials are different than baby boomers, so we just have to see what's going to happen.
But also a gigantic population number. The millennials are huge too.
I think trends you see, I think you see communal living right now. You have communal dining. You go to the brewery places, restaurants now. You sit at a table with somebody you don't know. So I think you'll see single people or couples living together because of the cost. I think immigration is going to have to be worked out in this country. Bottom line is we need population to come here. And somehow we got to figure out how we're going to keep people here and how we're going to get more workers here. You'll see a different change in the population. Or you'll do like the deal I made to my kids. I'm going to buy a really nice place for about $500,000 paid off in cash. You kids move in, take care of us till we die, and it's yours. So it's going to be, who do you want to give the $500,000, $750,000 to? I think that's the bottom line. What a lot of people are going to face. So I think you'll see new housing with differences. You'll have the mother-in-laws and father-in-laws apartments as part of it. I think you're really going to see a lot of liberalization from the local communities and acceptance of that. So that's kind of what I think that's going to happen.
All right. Well, I think we're out of questions. So before we wrap up, we got one more. Okay.
Casey, hey, my question for you guys is multifamily saturation. When I drive around, I look at balconies. I see all these brand new buildings in Uptown. When one opens, it seems like it's hot stuff. And then when another one opens, it's old news. And I see lights off. I see half-empty buildings. Do you guys feel like the new construction for multifamily is getting saturated? And if so, what is the future of apartments?
Stuart's the best, but I say past tense, it is saturated.
Let's have Stuart answer that. You have a...
It's all based on the vacancy rate, would you say, Stuart? I mean, if you...
All right. One of the things that I noticed was the building that is going on downtown Minneapolis. They keep building, but if you look at the number of jobs that are being added downtown Minneapolis, and I don't know if it's one for one, but it's working, and the trend towards the city has not, changed. Eventually, the millennials, they're getting married later in life, they're having kids later in life. All these things, I agree. Eventually, they're gonna go somewhere. They're gonna need bigger space. They're gonna be looking at schools, all those things. But so far, so good right now. What upsets the apple cart I don't know. But I think Todd's point, when we start seeing apartments being converted to condos, that could be one of the warning signs. So,
But I think once we see single family houses being built and a huge demand for that, because right now we're not seeing this massive demand for single family houses. People are still wanting to live in these apartment buildings. So if and when that shift comes, that's where I see it.
I just like to argue that shift is happening or is happening for houses under $200,000.
Yeah.
Affordable.
Yeah,
And that's why I'm saying Richfield is a gold mine right now, because they built all those World War II houses, and the millennials are going there because the transit has changed so much. Though you can get right downtown with an Uber or light rail or whatever in a matter of minutes. I have interns that work, we call them juniors at my firm, and they're in the mid-20s. They don't even own cars. They don't take a car anywhere.
Sick.
They just figure it out. It's so cheap.
what's wrong with them?
What's wrong with them?
Ridiculous.
American way.
I'll just make an observation. This is not my market, so I don't know it, but I thought I read that between now and, or maybe last year, I read between then and 2025, there's going to be 600,000 more people in the 7-county metropolitan area. Well, 600,000 people is quite a bit of housing demand. So it seems to me that the demand is going to be there, whether the affordability and other things are there, I don't know.
Well, I think one thing we all have to remember is everything's shut down, right? From 2008, there were still projects left, but from 2008 until 2012-ish, there was almost no building. So when you look at the whole trend, yeah, we're maybe higher right now, but let's look back, and are we really overbuilding right now or not? When you actually look at what we just didn't have any building that happened at all. So, all right, well, we'll wrap up. I want everybody to go through, just say their name again. And if anybody wants to contact you, how can they get a hold of you? If you don't want people to talk to you, then just say, I don't want you to talk to me.
I'm gonna start, Bill.
Does anybody want to talk to him?
Yeah, don't talk. No. Bill Licken, 952-913-8383, Crown Senior Living.
So Ian Colville, Carpathian Capital, that's carpathiancapital.com, or my phone number, 612-564-4066.
Could you think of a harder name to name your company? Because I couldn't spell that if I got it into my head.
That's why I left the phone number, I know.
Todd Wilson is my name. Go to our website, thormidwest.com.
Sweet. Scott Miller, Community Commercial, 651-283-6803. Thank everybody.
All right. Thanks, everybody. Well, special thanks to the 4 gentlemen that came on the show and provided us with valuable insight, both at the Minnesota Real Estate Exchangers meeting and through this podcast. So special thanks to Scott Miller, Todd Wilson, Ian Colville, and Bill Licken for sharing their valuable insight. And I hope you learned something from this great meeting, great networking, and we do it twice a month. The first Wednesday and third Wednesday of every single month we meet. And so if you want to learn more or be a part of the group, go on to mree1031.com and check us out. And we'd love to have you in as a guest. And then for the listeners, I'd love to have you subscribe. So if you're not a subscriber, come in and subscribe, go on to iTunes and click on the subscribe. And then also ratings and reviews. We're really looking for, your thoughts. So give us a rating, give us a review, and then spread the word. Let other people know what we're doing on this podcast, and spread the word. And we'd love to reach out to more and more people. I'm Todd Dexheimer. I am signing off. Make every day a Saturday.
Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today.